Hey guys, Nick Paynes here from Meta Homes and Remax Alliance. I'm going to talk to you guys a little bit today about some different investment vehicles, talk about the stock market and real estate. So here at Fairway Mortgage today, got Ryan helping me out, going to make an awesome video for me, so I really appreciate that. And so we'll just get right to it. This here, I want to start by talking about the kind of misconceptions of some multiple investment vehicles. So what we're talking about today is the first one is going to be real estate, investing in real estate. Second one will be investing in the stock market. So I want to show you kind of the two different returns that we're seeing, and we'll start with the more traditional stock market here. And when we're talking about returns, investment returns in the stock market, we generally use what's called stock market return with DRIP, and DRIP means dividend reinvestment program. And so generally speaking, in a long hold program, we are reinvesting our dividends. So if you look over to the right side of my chart here, we have actual return rates from these different decades for the stock market. So from 1960 to 1970, you can see we have a 7.39%, all the way up through the last 18 years at 9.29%. So we're going to use this number since this is the most, last 30 years. The 1990 through 2018, we have a 9.29% return with dividend reinvestment. Without dividend reinvestment, if you were to take your cash flow that your stocks were generating, would create more around 7%. So let's start out with using a $125,000 investment. In this beginning value here. So $125,000 is your beginning investment. And we're going to grow that investment rate at 9.29%. You'll see that our investment return is also 9.29%. So over a period of 30 years, okay, you can see our chart here, we're starting at 60, going up through 89. So 30 years, you'll have a balance at that time of basically $1.8 million, okay? So with a 9.29% compound annual growth rate, we have $1.8 million. So that's a pretty great return, a 30-year return with no additional investments. We start out with $125,000. Real quick, I want to distinguish the difference between compound annual growth rate and annual return, average annual return. So some people get those confused. They're two totally different concepts. So average annual return, the reason we don't use that is because, for example, if you had $100,000 to invest and you lost 50% in the first year, you would be down to 50,000. And then in the second year, you gained 100%, you'd be back up to 100,000. So your total gain would be zero. You'd be back to the starting place, but your average return would be 25%. So that's not a great way to calculate your actual return. Compound annual growth rate is what gets you that 0% return. So it's your total return in terms of the amount of years you've had your investment. So it is important that we're using compound annual growth rate and not average return. Okay. So the stock market return, once again, $125,000 over 30 years at 9.29% returns $1.8 million. Not a bad return. So now I'm going to transition to the real estate investment. Okay. So now we have a real estate investment growth chart here. And what I've done is, once again, done a little bit of research on real estate growth. From 1968 through 2009, so a pretty solid chunk of data, we've got a 5.4% per year return. Now, obviously, in the state of Colorado, especially over the last 5 to 6 years, it's been significantly higher than that. For 3 years straight, we saw actual double-digit returns as far as percentages. So that's a pretty incredible growth. But generally speaking, we're looking at about a 5.5% growth rate. So we're going to take that same $125,000 investment that we would have put in the stock market, and we're going to invest it into a property, and we're going to grow that property at 5.4%. So if we do that 5.4% over 30 years, which is the time it would take to pay off your mortgage, your investment will grow to $605,000. $520. So once again, not a bad investment. $125,000 turns into $605,000. Now at this point, we would ask, we might ask what investment is better? Which investment would be a better return? The stock market returning $1.8 million, or the real estate returning $600,000? 9 out of 10 people would say, well, of course, the stock market. You get $1.8 million. That is, it's true when you look at actual return against the total value. However, what we're not taking into consideration here is the actual power of leverage. And leverage is essentially a mortgage. So when you take a mortgage out on a property, a mortgage allows you to purchase an asset or have ownership in an asset that you don't completely own. So in the case of, for example, $125,000 property, as an investment, you would need to put down a minimum of 20%. So in this particular instance, $25,000. Okay, so $25,000 would be your actual investment. However, the property itself is worth $125,000. What's great about a mortgage is it allows you to enjoy the appreciation of the entire asset, not just the amount of money that you personally invested. So in order to compare kind of apples to apples here, we have to compare the investment power of your money. So if you have $25,000, not $125,000, and you invest it into real estate, you can buy $125,000 worth of real estate with only $25,000. The stock market is a little bit different. The stock market, once again, we're going to switch back. The stock market allows us to only invest the amount of money that we have. Okay, so we're going to take that same $25,000 and put it back in the stock market, and we're going to see what type of growth rate we have then. So at that same 9.29% over the same 30 years, our $25,000 investment becomes $359,214. So now, if I ask you the same question, which is a better investment over 30 years, $25,000 into the stock market or $25,000 into real estate, I hope you can see that the real estate investment is a better investment vehicle at this point. So it's definitely important to point out here that if we use the return that we look at in the investment growth chart, the real estate investment growth chart, and we take that $25,000 and we realize that our investment comes out to be over $600,000, our compound annual growth rate of $25,000 over 30 years comes out to be 11.21%. Okay, so instead of the 9.29% that we saw in the stock market, we're actually seeing almost an additional 2%. Now that may not seem like much, but over 30 years, using compound annual growth, it's incredibly significant. Switching back here to the stock market, I want to show you what an additional 2% does for compound annual growth. Let's take that same beginning figure of $125,000 that turns into $1.8 million, and instead of having a 9.29 growth, let's put in that 11.21 and see what happens. So that additional 2% took us to over $3 million. Okay, so going from 9.2% to 11.2% goes from $1.8 million to $3 million. So that extra 2% is really, really significant. Okay, so it is important to understand that this real estate investment strategy it really far outpaces the stock market, and this is as an investor. So the next thing I'd like to talk about is the ability to, if you don't already own your own home, purchasing your own home and what type of return we see on something like that. So here we have a real estate owner growth chart. This is different than the real estate investment. The chart itself is similar. However, in the instance where you are purchasing your own property to live in, we're going to assume a couple of different things. The primary idea is that if you're going to be living somewhere and paying rent, you might as well be paying mortgage. So if you're paying $1,500 in rent, there's no difference between that and paying $1,500 in mortgage from a, what comes out of your pocket standpoint. The difference is the appreciation and the asset that you have as a property owner. Some interesting facts. I don't quite recall the article I saw it from. It might have been from the New York Times or something like that. But there has been a nationwide study that has shown that homeowners have 11 times the net worth of a person who rents. And the reality is, it's not that they make any more money. It's not that they were better at saving. It's that the ownership of real estate increases your net worth dramatically because of that fact that you're paying to live anyway. You may not be saving any money into retirement. You may not be putting any money away for later in life, but your house is kind of doing that for you. It's a great investment vehicle. So in this particular instance, we're actually going to talk about owning your own home and what type of real estate growth we see with that, and the type of compound annual growth rate we see on your own personal purchase. So once again, mortgages allow you to build wealth. And what's great about a first-time home buyer is you don't have to put 20% down. So in the instance of a real estate investment property where you're putting $25,000 down in order to buy a $125,000 property, we actually end up in a situation where you can purchase, for example, a $125,000 property. We'll stick with that same number. Okay, and you can do it for as little as 10% down, 5% down, 3% down. And right now in Colorado, we've got great programs through CHFA that allow for down payment assistance programs where people are literally paying as little as $1,000 out of pocket to purchase a property. What's great about that is you end up paying a mortgage, which is similar to paying rent. But for as little as $1,000, you're creating ownership in real property, in real estate that appreciates, and you get to enjoy once again that appreciation on the entire value of the home. So let's look at a for instance here on a piece of property. So once again, let's say we buy a small condo for $125,000, and let's use a 5% down payment, okay? So a 5% down payment, 10% is $12,500, so $6,250, okay? So $6,250 is the amount of your down payment. Now, once again, that piece of property at $125,000 is going to appreciate at 5.4%, okay? If we take that 5.4% and extrapolate that over 30 years, your property is worth exactly like the investment property. It's worth $605,000. However, the difference here is your original investment isn't $25,000. Your original investment is $6,250. With something like that, our compound annual growth rate ends up well in the teens, 16, 17%. That's a pretty phenomenal figure. There's nowhere else that you're going to get that type of return on your money. There's been one person pretty much in the history of the world that has returned that type of money in the stock market, and that is Warren Buffett, who has returned somewhere around 19% since the inception of Berkshire Hathaway. But that's an absolute anomaly, and that's a pretty incredible thing. So anyway, this shows you kind of the power that even just having a minimal amount of money, 3%, 1%, 5% down can do long term for you. So just a real quick last thing here for this video, real quick real life example. I did have a client last year that purchased a property using CHFA with a $1,000 out of pocket cost. They used a government grant from Colorado, the CHFA loan that gives you a down payment assistance program. They ended up paying $1,000 out of pocket for a $330,000 property. Okay, so I'm going to put that in here, $330,000. So a $330,000 property, as it grows at 5.4% over a period of 30 years, once again using 30 years because after that your mortgage would hopefully be paid off in full, you would have an asset worth $1.6 million, $1,598,000, okay? your original investment was $1,000. So you invested $1,000, and after 30 years, that $1,000 was worth $1.6 million. That compound annual growth rate is 27.88%. That's a really incredible number. I'm going to switch back and show you what your $1,000 would have done in the stock market. If you put your money in the stock market at 9.29% and you had a $1,000 investment, your money over 30 years would grow to $14,369. So for those of you who are funding a retirement account, which is great, funding your 401k, putting money in a Roth IRA, but you're still paying rent, take a couple of months, maybe take a year, stop funding those retirement accounts, put some money aside for the down payment on a house. Because as you can see here, you can either have a stock that's worth $14,000 30 years from now, or you can have a home that's worth $1.6 million. Compound annual growth is an incredible, incredible thing. Mortgages are the most powerful financial tool on the face of the planet as far as creating wealth. Find a way to buy property, find a way to buy real estate, whether it's your first home, second home, third home. The idea here is there's no better financial tool to help you create wealth for your future. All right, guys. Hey, thanks for checking out the video. Really appreciate it. Hope you learned something from it. Hope you learned how important it is to own real estate, whether it's from an investment standpoint or your own home. Please give me a shout. If you got any questions, give me a call, email me, text me. I'd love to chat with you more about it, go into more detail. I'll do some more videos as well, talk about tax benefits, things like depreciation, and people that are gonna yell at me about not talking about the cost of capital gains and things like that. So I can answer all those questions for you in person. I'm happy to make another video. Really appreciate you guys checking it out today, and thank you.